Hello, this is Gary Sherman of Whaddadunce.com. In part two of our series on bank valuation, we will be talking about bank ROA and ROE. ROA is the after-tax return on assets, and ROE is the after-tax return on equity. And these are the primary drivers of bank value. And we will use Bank of America as our example company as we go through the numbers. In this slide, we present the model parameters from part one. And again, this is for Bank of America. And these are the parameters, values that we need in order to calculate a bank's ROA and ROE. But we should note two things. Number one, on the capital assets ratio of 7.78%. Banks, in order to get a small return on assets, most likely less than 1%, into something meaningful, you have to use a lot of leverage. And banks are all about leverage. From the bank's perspective, they want to get that capital assets ratio as low as possible. But the entity that will prevent that from happening is the bank regulators, because they have reasons to want to have that number to be as high as possible, which runs counter to what the banks want themselves. Also, on the net charge-off ratio, the ratio for Bank of America for 2025 was about 48 basis points. And this is a best of times ratio. So if you look at the time series for the all banks over the last 20 years or so, that 48 basis points is comparable to the low point in that time series. So that net charge-off rate is understated, and we're going to have to use something higher than that go forward. The first calculation that we want to make is a net interest margin. And for our purposes, we define that as the numerator being interest income minus interest expense, or basically the spread business, divided by my asset base. NIM, the first equation there, NIM01, that defines what net interest margin does or is. And then we work through all the way down to the last equation there, NIM03, where we actually plug the values from the model parameters slide, the previous slide, into that equation. So we get a net interest margin of 0.0182 or 1.82%. The next calculation that we want to make is non-interest income. And if you look at the first equation there, NII01, that's our definition of non-interest income, which is the non-interest income from the income statement divided by my base assets. So we take that equation, we work all the way through until we get that last equation on the slide, which is NII03, where we actually take the model parameters or the values of the model parameters from the previous slide, plug them into that equation, the equation above, and then we get a net interest income of 0.0160, or basically 1.6%. The next calculation we want to make is non-interest expense. And if you go to equation NIE01, that's our definition of that ratio, which is basically my non-interest expense from my income statement divided by my asset base. So we take NIE01, we work it all the way through until we get the last equation on that slide, which is NIE04. And we take the model parameter slide, plug the values into that equation, or the equation above, and then we get a net interest expense of 0.0211, or approximately 2.11%. The next calculation we want to make is net charge-offs. And if you look at the first equation there, NC0 or NCO01, that's our definition of the net charge-off ratio, which is a net charge-offs from the income statement. In this case, we use the loan loss provision as a proxy for net charge-offs divided by my asset base. So we take, just like in the previous slides, we take NC0 or NCO01, we work it all the way through to that last equation, NCO03, and then we take the model parameters, the values of the model parameters from the previous slide, plug it into the equation, and we get a net charge-off ratio of 0.0017, or approximately 0.17%. So now what we want to do is calculate Bank of America's return on equity. We can take the calculation from the previous slide and we'll just plug that into the table. So the first item is a net interest margin, which was approximately 1.82%. You can go back to that slide. And then we want to add in the net interest margin is a spread business, and then non-interest income is the fee-based business. And we want to add that in, and that's 1.6%. Then we want to subtract out our non-interest expense, which is employee compensation, the rent paid on my branches, my computer systems, and desks and chairs, and all that kind of stuff. And we want to subtract that, and that's 2.11%. Then we want to subtract out our net charge-off ratio, which is approximately 0.17%. And then we get a pre-tax return on assets, which is a little over 1%. And remember that Uncle Sam wants his piece, so we have to pay taxes, and I think we use a tax rate of a little over 19%, which corresponds closely with the if we look at the federal maximum federal tax rate is 21%. Add in my state and local taxes, and then subtract out any of my tax credits. So 19% is a good number to use for income taxes. So subtract that out, and we get an after-tax return on assets, or an ROA, of about 92 basis points. And this is, so if you have remember that we talked about Costco in the previous sections, and we noted that Costco's returned, or that their margins were around 4%. So if Costco makes $100 sale, what flows down to their bottom line is only about $4. And you might look at that and say that's pretty low, and that's pretty comparable to what grocery stores have very, very low margins. But banks are in an extremely low margin business, so they have a margin of less than 1%, and you have to get something meaningful. How do you get that 1% up? You use a lot of leverage. So therefore, we divide the after-tax ROA of about 92 basis points by my capital ratio, which is 7.78%. So now we have an after-tax return on equity of about 11.83%. And this after-tax ROE is going to be the primary driver of bank value. In this slide, we calculate the cost of capital for Bank of America. And this slide takes a screenshot from the software, so we don't have to go through all the pain and suffering of actually calculating that rate. We could just note a couple things. Number one is that green arrow. What we do is rather than calculate the cost of capital just for Bank of America, we take the industry as a whole, which is more stable, and we use the numbers from the industry to calculate cost of capital. Then if you look at the black arrow there, those are our cost of capital parameters. We have a risk-free rate of about 4.41%. That is the 10-year Treasury rate. And then we have the equity risk premium, which is what the market demands over and above the 10-year rate because they're taking a lot more risk. And that's about close to 5%. And then the blue line, or the blue arrow, we calculate the cost of capital for the industry, based on some of the particulars for Bank of America, and that's about 8.78%. And note that the orange arrow is the equity beta of 0.88. That's for the industry, the banking industry. Basically, what that says is if you compare risk from banks versus the market in general, banks are less risky, but not that much. The equity beta for a average S&P 500 company would be 1. And so therefore, given that Bank of America's equity beta is less than 1, it's going to be less risky than the market as a whole. And in the yellow boxes there, what we've done is we've basically, we can override any kind of cost of capital that the software calculates. But in this case, the software calculated 8.78%, and we're going to use 8.8% to get a nice round number. In the previous slide, we calculated Bank of America's return on equity and its cost of capital. And remember that the software is there to take care of all those calculations for you. so you don't have to go through all of that pain and suffering. But rather than just view all these models as a black box, we're going through the mathematics of exactly what's taking place under the hood. But from a go forward standpoint, you really don't have to worry about that because all of those calculations are made for you. So if you take a look at the valuation equation MDLO1, that was the valuation equation that we derived in the series on valuation basics. And basically what that says is the value, in this case, the value of Bank of America's common stock in total would be W minus G, which is W is the after-tax return on equity, which is 11.83%, minus a growth rate, times my asset base, which was the 3315 number, times 1 over K minus G. K is the cost of capital, which we estimated to be 8.8%. And that's the base valuation equation for doing a quick and dirty valuation. So the first thing we need to do is we need to calculate the growth rate, or the parameter G. So if we take a look at that first table there, that is Bank of America's 2025 and 2024 assets. And if you do a simple calculation, the growth rate in those assets just for that year between 2024 and 2025 was 4.69%. Now, the 10-year Treasury rate is a good good indicator of, historically has proved to be a good indicator of GDP growth. So we can we use a 10-year Treasury rate of 4.41%. So at the end of the day, what we're going to do is, for our quick and dirty valuation, which we'll do in the next section, we're going to use 4.5%, which is kind of the halfway between those two numbers. Now remember also, we look at the table below that, bank leverage. Remember that the banks are all about leverage, so they take a return on assets or a margin less than 1, and they use a lot of leverage to get that number up. So we end up with a return on equity of 11.83%. Then if we go to that at the top of the page, the second table, those are our model parameters for our quick and dirty calculation. A subscript 0 is my assets at time 0, which is the 3315. That comes from previous slide, or from the model parameter slide. W is my after-tax return on equity, which we just calculated. K is my cost of equity capital of 8.8%, which we just calculated. And G is my long-term asset growth rate, which we determined, at least for the quick and dirty run, at about 4.5%. So we have two options when we run models, and both of these models are in the software. And we're going to increase, as users contribute, their models. We can incorporate those into the software as long as the models are financially sound, as far as they comply with financial theory and anything that common sense. So the standard model that uses that assumes that we take the model parameters like we're doing here for Bank of America at any given time, and just plug that in, assuming that those parameters hold in perpetuity. This is a quick and dirty way of getting a value that's indicative of whether we're overvalued or undervalued. Now the mean reverting model is more complex. That assumes that we have short-term parameters and long-term parameters. The short-term parameters are unsustainable, and they mean revert to the long-term sustainable rates over time. And that is a mean reverting model, and we'll use that too in the next section. So come join our community at Whaddadunce.com. It should be fun.